The second category of financial markets are known as derivatives, which is a contract-based trade that derives its value from the risk of a security. Derivatives can be defined as a contractual agreement to buy or sell a security by a specific time. There are two popular types of derivatives, which you may have heard of, that being options contracts and futures contracts. Options contracts are financial instruments which derive their value from the underlying asset. The underlying asset of an option is simply the stock or security that the option is based on. In other words, the risk and price movements of the asset, let's say Apple, directly affects the price of Apple's option market. So you may ask yourself, what is the difference between an option and an underlying asset? They are both based on price movements of the stock itself. How are they different? Well, the options are priced using multiple properties, and this is what I was referring to when talking about derivatives. Price action is not moving entirely from price action alone. There are other properties which are known as option Greeks, which primarily include delta, gamma, theta, and vega. Delta is the direct change in price in the underlying asset, which ultimately changes the price of the option. Gamma is a change in delta, which can lead to exponential growth or decay depending on your options contract and how price is moving. Theta is the change in volatility within the underlying asset, which can influence the price and the asset's option. If the underlying asset's price is not moving too much or is not volatile and suddenly skyrockets in volatility, the option will move even more dramatically and vice versa. The Greek theta alone can make options extremely volatile and extremely sporadic, so to speak. Now, of course, if you're trading during quick and aggressive price movements, options can be extremely profitable. Equally so, if you are trading during these quick and aggressive price movements within a market, but then we see a big drop in volatility, you could experience significant losses. The final Greek is known as vega, which is the change in an option's price due to the passage of time. This says that as time passes, the value of your options contract decreases. This means that the options traders do not typically hold their trades for too long as compared to their expiration date. So every options contract has an expiration date, which means that it will have zero value at that date. This is due to vega or time decay. For these reasons, options contracts can become extremely difficult to price and ultimately trade altogether. Now, with that said, let's get into some explicit benefits to options. One is that options require very little capital to trade with. Since they are leveraged, an individual's portfolio can realize exponential growth so long as they are consistent and manage risk well. As I had already mentioned, options contracts are used best when markets experience high volatility, as the option can multiply to significant levels. An individual who trades best within highly volatile markets may be suited best with options. But of course, there are two sides to every coin. This can also hurt the trader equally as it is beneficial. Trading poorly can lead to dramatic losses within options, and lacking the necessary knowledge on the option Greeks can make this even worse. They are a very complicated type of financial instrument at its core, but in turn can provide massive upside potential. Now, I think this is a good time to mention that options are a contractual-based asset, which is different from stock and bonds. Derivatives as a whole, including both options and futures, are based on contracts, not shares or the stock itself. While there are some technical differences between contracts and shares, the primary difference you should be aware of is that contracts are based on margin, while shares are not. Remember, shares trade directly based on how the underlying asset moves. Contracts also move in congruence with the underlying asset, but do so exponentially. So to put this into perspective, let's take on an example. One options contract provides the individual with 100 shares of the underlying asset. This means that if the underlying asset or stock is worth, let's say $300, our options contract is leveraging a $30,000 position. Now, depending on the volatility, abundance, and expiration date of the option, the pricing can change. Although for simplicity reasons, we will assume that one options contract will be roughly the price of one stock of the underlying asset. This means that we are spending roughly $300 to trade a $30,000 position. Now, of course, this is simply a hypothetical. Quantifying the leverage and associated risk with an options contract can be very difficult when considering the different Greeks involved in pricing. So, this leverage can actually be much less aggressive or significantly more aggressive. At one point in time, our options contract may be leveraging a hypothetical $30,000 position, and 5 minutes later, it may be leveraging a hypothetical $60,000 position. This means that the leverage ratios vary substantially, something that is critical to understand before getting into options. I will not be going over this in specific, but I am happy to answer any questions that you may have regarding options. Just shoot us an email or use the questions page on our website. Now, moving away from options, we could get into our second type of derivative, known as futures. Futures are a type of contractual agreement to buy or sell a specific asset at a future date at a specific price. This may seem confusing at first, but futures can be traded and viewed similarly to equity or stock. The obligation to buy or sell at a specific date and price is simply saying that you must perform this action at some point in time in the future. Similar to an options contract, the contract holder must close the contract at the expiration date. The only relevant difference between the expiration dates of options and futures is that the futures contract is sold at a set price, no matter where the current market price is, as opposed to options which are closed as worthless. As you can imagine, a high-frequency futures trader doesn't really have to worry about this feature of futures contracts. I personally trade futures and treat them just like stock, and that is ultimately why I have found myself trading futures. This is because futures come with the benefit of having organic price action similar to equity and bond markets. Unlike options, there are no Greeks involved with futures. This makes the risk assessment significantly easier, as we do not have to worry about changes in leverage ratios as we do in options. Still, it is important to understand that futures are contractual, meaning they do come with significant leveraging capabilities, which inherently increase the risk associated with each position. This, of course, also allows income to be generated from much smaller account sizes while still taking advantage of organic price action. I see futures as a nice mix between equity and options, as you benefit from organic price action from traditional stock markets while still having the ability to take advantage of leverage. Now, while this might sound all fun and exciting, I do want to talk more about the risk involved with futures, as this is what ultimately matters in regards to trading. It is entirely about preserving capital. So, we understand that derivatives are traded on margin, or traded on borrowed money. This can be otherwise known as leverage, which ultimately increases the risk associated with each trade. The problem with this is that derivatives can only be traded on margin. It is a requirement, which means that you are required to take on this additional risk. This can be extremely dangerous, as you could technically lose more money than you have, which would mean that you are unable to pay back your margin or the money that you had originally borrowed. If this occurs, you may be put on a margin call. A margin call essentially demands the trader to deposit additional funds into their account, which basically pays back the broker. If this is not done, there can be some rather severe consequences. Interest can accrue onto this margin call, and the trader may have to pay back even more than they had originally borrowed. If the margin call is not paid back, typically within 1 business week, the account may be restricted to trading only on a cash available basis for up to 3 months or until the call is met. This essentially means that the trader will no longer be able to use their margin. While rare, failure to meet a margin call could also result in a negative impact on your credit score, as the margin is deemed unpaid debt, and in even worse cases, your broker could take legal action to recover the debt. While I am saying all of this, I do not mean to put a bad name on derivatives. I trade futures, and I have never been close to going on a margin call. If you are able to manage your risk properly, you can reap the benefits of leverage while avoiding the consequences that come with irresponsible trading activity. Now, I've said this before, and I am going to say it again. If you are new to trading or haven't traded at all, it is highly recommended that you do not trade on borrowed money. In fact, many brokers require the trader to fill out an application form to apply for a margin account, which typically involves information on your financial status, trading experience, time horizons, and risk tolerance. You may also be required to provide credit reports along with qualifications and overall experience. This is usually enforced to eliminate all possible individuals who are at an increased risk. In other words, they do it to help you not lose money. Another benefit to futures markets is that the PDT rule is not enforced, which means you can freely trade as many times as you want, even if your account is worth less than $25,000. Futures markets are also generally very liquid, meaning you have the freedom to enter and exit positions where you please, which usually doesn't involve much slippage, if at all. Since futures markets are based on the risk of an underlying asset, these markets are very selective, only traded on the most active of equity markets and indices. Now, one final feature I would like to mention about the futures markets before we move on to currency is that futures are much more efficient in low volatile phases of the market as opposed to options. Remember, options are the best in volatile phases because their growth is exponential as volatility increases. With futures, growth is linear, similar to stock, since price is based entirely on the price action of the underlying asset. So, volatility doesn't matter. This means that if you do want to trade derivatives and you do like stable and passive markets, futures is probably the way. Now, this is a very specific feature of derivatives, so I wouldn't worry too much about this if you are a bit confused. But that does close off this lesson on derivatives, and now we can move on to currencies.